What if everything you think you know about venture capital risk is wrong?
If you do it with funds of a certain caliber, which are nicely diversified, the risk of losing money is negligible.
But our survival brain tells us otherwise.
You need to stay alive. You need to avoid the tiger.
The reality? Success in VC isn't random, it's predictable. And the best funds share something specific.
An edge in terms of sourcing, screening, winning, managing.
The data proves it.
VC outperforms every other asset class as an asset class.
So why stay on the sidelines when you could be funding the future?
Get as much money as possible into fueling the future, into primary cap, in money that makes you proud at night when you go to bed.
How does Bluegrass Ventures turn cautious LPs into purpose-aligned outperformers? Join us on the EUVC Podcast as David Vlerick reveals why the smartest money is moving from secondary comfort to primary creation.
Before we start the show, a quick note. If you're building or running a fund, you know it takes the right partners. At EUVC, we only work with sponsors we truly believe should be part of your tech stack. Please do take a moment to hear about them. And if you do, reach out, mention EUVC. It's the best way you can support what we do. Thank you so much. Starting off, HSBC Innovation Banking. If you're a founder, a scale-up, or a VC, you need a bank that actually understands your world. HSBC Innovation Banking backs innovation globally, from seed to IPO. And if you ask me, a strong banking partner like HSBC belongs in your stack. If your portfolio companies are scaling, they need infrastructure that won't slow them down. Google Cloud Starter Program offers $2,000 to $350,000 in credits, plus technical support to build better and faster. It's a key boost every fund should bring into their ecosystem, and oh my God, are we thankful to be partnering with them. Now, legal is a space you cannot lag on. Legal needs to move at the speed of venture. Goodwin's team has decades of experience with startups and funds. They're trusted at every stage from formation to exit. Goodwin definitely is a legal partner every serious manager should have in their stack. For Luxembourg-based VC, PE, and fund of fund managers, modern funds means going digital. Fundcrafts gives you a full-service, digital native platform built for today's European managers. It's a must-have if you're scaling smart. So we all hear about the Middle East. How about you go there? From AI to deep tech to sovereign fund, Skytech in Dubai is where global future of tech gets negotiated. It's not just a conference, it's where East meets West, capital meets innovation, and the bold set the agenda. If you're playing on the global stage, join us going to Skytech this year. If you're gearing up for a next fundraise and want a placement agent who truly understands emerging managers, reach out to C Funds. They're a boutique placement agency that has helped GPs across Europe raise capital from top-tier LPs. We've been on the other side of the table here. They are actually good ones to work with. So I do urge you to go to cfunds.io to go and check them out. And hey, before you go, if you're looking to discover startups, raise capital, or connect with innovation leaders, do check out dealflow.eu, the EU-backed platform bridging founders, VCs, and corporates. There's no better place to find the startups that have received significant funding from the European innovation ecosystem.
This was their finest hour.
Tear down this wall.
It's more than just an alliance. This is a union of values.
Let's start acting.
This show is not investment advice, and the hosts of this episode may be invested in the funds and companies featured.
Welcome to the EUVC Podcast. As you know, we're here to showcase the depth and breadth of European venture, to platform the people shaping it, connect the ecosystem, and hopefully spark conversations that matter. Today's guest brings a perspective that I believe does exactly that, blending venture values and I'd even dare say a very human take on the future of capital. So please welcome my homonymous, I don't know if that's a word in English, I guess it is, David Vlerick, founding partner at Bluegrass Ventures. His investment philosophy is rooted in a fund of funds model with an emphasis on quality selection. If you know anything about myself and UVC, you know that we very much agree with this worldview. So that's also why I'm so excited about this. And David believes that, and now I'm quoting, in a world characterized by accelerating change, increasing complexity, and tremendous competition, backing top-notch venture capital funds is the most surefire way to increase wealth while shaping a brighter tomorrow. David, welcome to the show. Do you want to give us a quick introduction on who you are and what brought you here?
Definitely. Thanks so much for having me, David. What brought me here and who am I? I'm from Belgium, maybe first and foremost. Studied law a long time ago, then did management school in Ghent, and then kind of stumbled into finance, initially by lack of, let's say, a better plan or a better objective. and liked also a little bit after the law school the more figure-based approach of life or of work life, let's say. Then I went into private equity for a while, worked at 3i for a bit in Amsterdam, which kind of opened my eyes to the world of investing and to the excitement behind it, the analytical part of it, which I like a lot, analytical, creative part also, because you have to kind of make a whole idea of what a company looks like. And then also, on the other hand, the people side of it. You're always dealing with people, you do things together with people. So I liked the combination of these two. Then they shipped me off, so to speak, to London to do some M&A in a proper bulge bracket bank, where I was an analyst for UBS for a while. Was not the best job in the world for me, as it was very, let's say, automatic, very draining, very not very colorful, I would say. You learn quite a bit, and I was super happy to be in London, had a fantastic time there. Then moved again into mid-market private equity and M&A, and then joined the family office about 10 years ago. Family office, which is more like an industrial group, started off as a textile group, like many companies in Belgium, carpets, branching out into other textiles like denim, then other industries. Financial services is an important part of the group as well. And by accident, we started investing a lot at VC. As it happens, kind of, I was sitting here in the same office and deals came into my inbox. We looked at, let's say, 3 deals all the time, and then we would assess them on value proposition. We did a few calls. We got to know the people behind it, and we chose to invest in one of the 3. Then we realized in VC, this is probably not the best way around this rather sophisticated asset class. So we also started investing a bit in small to mid-sized funds and co-investing with these funds. Now, at some point, our board told us, like, okay, shouldn't you only invest in top-notch funds and co-invest with these funds and stop the direct investing, which we did at this point. That's like 2-3 years ago, which gave me a little bit of latitude. And I had been thinking about doing something else for like 3, 4, 5 years before that. I said, okay, what can we do in venture capital that is a little bit different than the existing things, which is like either fund a fund or a fund themselves. Say it's construct more like a platform whereby you give investors the nice structure and a nice selection procedure of how you get to a selection of certain funds, but they have full flexibility to choose in which funds they invest, and the fee model is dramatically different. And so we set this up, me with my brother-in-law, who's a great friend also. He married the sister of my wife, and we lived together in London. He was doing London Business School. He used to work at McKinsey after that. So the two of us, he's in London, I'm in Belgium. We set this up, and it's been a wonderful journey so far.
And so just to get kind of the stats out of the way, or the definition out of the way. So you're the founding partner of Bluegrass Ventures. Bluegrass Ventures is HQ'd in Belgium, correct? Even though your partner's in London, yeah. You do mostly early stage VC funds. You can do other stuff, but this is your focus. Geo-wise, you're quite open, quite flexible as well. You're not like focused on specific sectors or verticals. You've backed a couple of funds top of mind. Do you want to share some of your notable investments?
Yeah, sure. But so maybe first on selection procedures. So small to mid-sized funds, never the large funds. Very important. Proven track records, because we have to also, because otherwise it would be more difficult to sell, especially if you look at the characteristics of the asset class, which high levels of persistence and performance. The good funds tend to remain good funds. So proven track record, yet often emerging managers, according to the definition of it, like fund 2, 3, 4 is not a problem for us. But what's most important is top-decile track record. And more important than that even is a distinct unfair advantage, an edge in terms of sourcing, screening, winning, managing. An edge it can be either doing the thing everybody does in a better way, or it can be being the best of class in a certain niche. That said, we're also never going to select niche funds in the sense of the newest tech vertical, and let's all pile money into this because this is the future, but it has unproven trajectory, let's say. So we avoid these hype cycle plays, as we call it. But we could do more like infrastructure niche things, or for instance, fintech. In terms of funds, so we've started 2 years ago, a little bit less, May 23. And we've backed 5 or 6 funds, 5 funds so far. First one was a European one, because we always try to construct a portfolio which is quite complementary. So Europe, US, and then emerging regions. Every year we try to have like one fund of each at least. Often it's 2 US, because there's little preference for US from our Belgian investors. First one was Picus. Maybe you know them. The Rolls-Royce of European venture capital. They're linked to Picus Capital, which is highly successful as a holding company, investing in very early stage pre-seed seed companies. And they do everything in a more systematic way and with better and more manpower, so to speak. Huge team, huge network. The funds then invest in the winners of the holding with a double advantage of access and information advantage to they know these companies more intimately. Second fund, Y Combinator, Silicon Valley. It's a bunch of alumni grouping their money and investing in the top 20%, doing small ticket investment, top 20% of each YC batch. Again, super good team at the helm. The fact that they do these kind of widespread, and so investing in the top 20%, it's like 60 companies per batch, so very diversified portfolio, yet with a double quality filter, YC and themselves, and small tickets. So they have win rates, which are like best in class in the ecosystem, like about 95%. Makes it for a very, let's say, predictable, high quality financial product in Silicon Valley in Y Combinator. Third fund, a little bit the same guys from the Y Combinator network. Brian, also a genius actually, who used to live in the US, was a successful entrepreneur there. And then they decided, him and his partner, to set up an accelerator in Southeast Asia, which copies what Y Combinator does. Leads to huge deal flow, because they're like best in class accelerator, huge deal flow and quality deal flow, and also attractive entry valuation, because they can kind of price the valuation that these companies, that they invest in these companies. Fourth one is our first Rising Star fund. Rising Star means that we back very successful fund managers who set up shop on their own. Typically, they left the fund because the fund became too big. They want to do it in the right dimensions with the right setup from the get-go. It's a fund called Shapers by Phil. Maybe you know him, Phil, one of the most connected.
Fellow Portuguese guy. Yeah, Phil Teixeira da Mata.
Portuguese
Yeah,
guy,
exactly. Let's celebrate the Portuguese people in ventures. Thank you, David. Yes, I know him. FinTech guy, former head of Sophia investor. Yes.
Exactly. Super scaled, super connected, the right setup. He's not doing it by himself, but he has a network of 50, let's say, venture partners, the Shapers Club, who help him sourcing deals, assessing the deals, winning the deals. So very excited about that one as well. And then also a little bit out of topic, because not VC, but guys who we're very close with, super driven, and do something that makes a lot of sense these days. They do direct to cap table, small ticket secondaries in highly successful, privately held, yet on the way to IPO tech companies.
Yeah, very
They're
cool.
called Artea. Great guys.
Okay. Very cool. And so
And we have one co-investment, David.
already,
Really,
one co-investment already. That's exciting.
but we did it a bit, I don't know if we did it the right way. First co-investment, we served to our rather, let's say, I wouldn't say conservative investor base, but half of our investors had never done VC. And then now we sold the VC story. They said, okay, doing this via you with the nice quality filter and the diversification and the correct structure is probably a good way. Then said, yeah, we're also going to launch co-investments. And our first co-investment was like this hardware, deep tech, super early stage co-investment. And it was difficult to get some people excited.
I can imagine. It's not the easiest sector to invest in. I want to ask you a question before we kind of go with what we had planned to talk about. How do you think about sector-specific or sector-focused funds? Because you mentioned something around hypes and trends and all of that, which is quite common, I'd say, sense. But I think where it's sometimes hard is like when you start looking at some of these sector-specific funds, which part of me personally believes this is one of the two models I believe in the most within venture. But the other side as well, oftentimes, this comes with a lot of trend-ish kind of hype-ish prediction associated to it. Best example, defense-focused funds, right? Defense-focused funds versus deep tech funds, right? I personally have an opinion, but we could talk about computational biology as an example and these topics. How do you think about it? How do you navigate it yourself?
It's a little bit binary. So you have the sector-focused funds, which are also making a prediction about how fast that certain sector is going to scale. And so how fast the adoption will be. This is dangerous. This would be like the hype cycle thing, which is hard to predict. Maybe there's a lot of adoption and it slows down. And there are the sector-focused funds, which are investing in a sector that is firmly on a very visible, very predictable trajectory. The second one is probably for us the better way to go, because the first one, you may be very successful, but we cannot, and that's something we really try to avoid for our investors, we cannot guarantee, quote unquote, that even in a not super optimistic scenario, those funds will perform decently. Let's say 2.5x, hopefully 3x. So we tend to focus on the latter. What I see a lot of people do, what I see a lot of good VCs do, and what I like is saying, look, we follow the brains. The good teams, the smartest guys that go towards a certain sector and set up companies in that sector, we follow these guys because they know once if they do it, they'll be likely more successful because of the brain power they have and the teams they build. Plus, they may have the better nosy. So yeah.
So I guess you didn't say this. I'm kind of inferring from it. So correct me if I'm wrong, but it feels like you have a bit of a bias, and not in a bad way, a bit of a bias for the more kind of agnostic approach to venture, but either because it's a region advantage or edge, or it's a network advantage or edge, something like that. That feels like that's closer to your heart maybe than these more pure play sector focused.
Totally.
Yeah.
Clear edge, but generalist funds also because we are a platform. So every fund has to really stand there and has to have, let's say, have very good protection on the downside, because we have some investors, maybe they have only, our minimum ticket is 100,000. Some people have 100,000 and that's what they can invest in the next 5 years. I want to be comfortable telling them, look, pick this fund, pick the other fund. They should all be fine. There's no stress.
So we'll come back to the platform topic because I do want to talk about that, and it is a topic that I like. But first, I think it's also interesting to talk a bit about the person behind Bluegrass, in this case, you, David. You are a very interesting chap. I've learned in preparing for this, where you have many layers to yourself, which was a very pleasant surprise. You said a couple of things that I thought quite interesting. Two of them were your learnings around being a father, and the second one being how travel, poetry, and the outdoors shaped your early years. So I'll let you take whatever you prefer, or both, but I'd love to showcase that side of yourself as well.
So yeah, in my younger years, especially at university, we started traveling a lot. I started traveling with friends quite a lot. And because there was a huge thirst to get to know and experience the world, see different places, meet different people, and kind of drench yourself or absorb the whole, what it means to be young, let's say youth. And that was very forming in the way that the one big lesson always is, you go to many, many places. And the one thing that always comes back is people are exactly the same everywhere, have the same tendencies, and people love people. So it's relatively easy. Maybe the best example there is I traveled through South America for 9 months in 2009. It was a wonderful period. It was a thrilling period, let's say. I was about 25, 26, and 25. And I went from place to place. So I stayed 4 days in one place, big city. Then I would go to some more like hip kind of beach place. I started with Brazil for 3 months. So it was already
not too bad.
Perfect landing. And it's surprising because every 4 days, again, you have to rebuild a life. You go from 0 to 1 on a personal life level. And it gives you such a perspective, such a freedom that you say, I could build my life anywhere. I can build my life. I can make ties. I don't really depend on anything nourishing me. I can just build a little life here and there. And at the time also, because 9 months travel is a long time. And I had a very strict, but a very structured upbringing, very structured and with lots of activities. So I said, I need some structure in my life. So what I started doing is running 10K per day. I used to run quite a bit before, not really running, I used to cycle, but lots of endurance sports. And started running specifically then. And then also reading. I was reading all the beautiful novels of the past, so minimum 100 pages, and poetry, minimum 3 poems a day. So I started writing a whole lot of poetry, which I also started before at university already. And it became a life in that small period of youth. It was purely focused on how to experience life to the fullest and how to feed your soul to the fullest and to express whatever that soul, let's say, experienced. So it was, in hindsight, magnificent, because you always think you can do it at any time in life. But that's
the best time is now. The best time is now. How does that, when you zoom out, right? I'm sure there's a bunch of personal learnings from that. which we could go on for hours, a bit off topic. How does that inform you as an investor, though?
Yeah, good question. Because you've seen many people from different places. So you tend to have, I guess it helps in kind of understanding who the people are, what drives them. It also helps a lot in connecting with people. And in the end of the day, and I really see that also with Bluegrass, I mean, there is the rational selection and it's based on all these, let's say, filters that we construct. But in the end, you also have to get along with the people. There needs to be click and match. And that certainly helps in that respect as well. And the poetry helps in writing a nice email.
So your investors get great poems every quarter. That would be fun.
I lost it a bit to practice it.
The other one I have to cover. I had my firstborn 8 months ago or so, and you say being a father taught me that quantity time beats quality time every day of the week. Just be there.
Yeah. Exactly.
What do you mean?
I have 4 daughters. So first, the oldest one is 8.5 now. Then the second one is almost 7, and then 4 and 2. Yeah, it's just been an amazing journey because initially, before you're a parent, you are super self-absorbed. This is it. You are the alpha and omega, and it's all the rest of it. And then these little creatures start living inside your realm, inside your cocoon, and because they're there, and because you see them every day, you're so engrossed in them, and it became for me, it's like a huge love story in a way. It's full love. I love these girls to a very extreme degree sometimes, and I try to be there a lot. I remember when the third one was born, and I was the fourth one somehow I already, because the third one was important. I had this huge wave of gratitude and wealth. I felt super wealthy. Really, the feeling of wealth. Money cannot give you that, but this gave me a feeling of wealth. I was like, look, I have these 2 princesses and we have another baby. And it just keeps something unbelievable. And so, yeah, it's something I want to stay close to them. I want to know who they are, what they do, which has a second component of spending time. It's also trying to understand them, which is not easy because you are yourself fundamentally. So you always project. And I try to be around them all the time. So whenever they have their breakfast in the morning, I'm doing my exercise, primal movement. I'm kind of running around there. I just listen to their conversations. Sometimes I dip in, I chip in, sometimes not. So in a very fluid way, I try to be around them as much as I can. Also in the evening, I try not to go to every event, despite the fact sometimes I think I should go for Bluegrass. I may need meet an investor, but you cannot live life.
That's the major struggle of venture, but it is a champagne problem. Let's be honest. There's much worse careers. Having that said, I won't dwell too much on this, but I do love getting to know our guests a bit better. You shared some really interesting notes offline before we started this around your learnings in venture, and I think this is kind of interesting also when we go back to what you shared about your way into venture, like how did you end up where you are now? So I think it's also interesting to remember that to our audience. Your first one is something that we talk a lot about, so I'm probably not going to give you too much time to talk about it, but I want to let you kind of talk a bit about it. But most people wrongly conflate the risk of investing in startups with the risk of investing in a strong and diversified VC fund. And you say the two are worlds apart. Do you want to just expand a tiny bit on this, especially because you're building a platform, so you get a lot of exposure to this kind of worldview
all the time, and it's human wiring. My brother wrote a nice book, not in English, but about why we are not happier, and it starts with how human beings are wired. And it turns out, because we needed it back in the day, that we are always overemphasizing the negative or the potential risks, because that is going to make sure that we are safe, and being safe is the most important thing. Not harvesting the apple when the apple is harvest worthy is missed opportunity, but you need to stay alive. You need to avoid the tiger. And so for people in general in VC, and I find it with all our investors, they always think those funds are investing in startup. Then they think about a startup, and I'm like, yeah, startup. Those guys that can go anywhere, they may fail, so lots of things can happen. And it's very hard for them, one, you should look at the data that we have on venture capital fund performance, which helps. Just look at the data and then base yourself on it. But it's very difficult for them not to continue thinking about, but this is a risky asset class. Whereas if you do it with funds of a certain caliber, which are nicely diversified, the risk of losing money is negligible.
Yeah. Can I ask you to expand on this? Because now we're shifting a bit into bluegrass and portfolio construction and how you think about it. But I think these two connect super nicely because, as you said, look at the data. And if we look at the data, I don't know it like exactly to detail, but what we see is venture can yield returns. Yes, it has, there is a proven track record of the asset class. Yes, it's super interesting. However, dispersion is there, the power law is there. And that's when this portfolio construction topic comes to mind. So can you just expand on how you thought about it?
So one on the performance. VC outperforms every other asset class as an asset class. Or if you go to the granularity, the mean or the median, or both probably, return of VC is about the same as private equity. And it's much better than funds in other asset classes. But then the top 25%, top 10% score much higher than the top 25, top 50% of private equity. The bottom 10, 25% is to be more avoided than in other asset classes, so high dispersion. Very true. But so good performance, but you need to have a good selection. The great thing about VC is that selection is not all that difficult, even if you only base yourself on track record of these funds, because as previously mentioned, there's higher levels of persistence in performance in VC than in other asset classes. So the good ones tend to remain the good ones. And why is that the case? It's because it's specialist work. Specialist work in the sense that you need to have access to the right deal flow. You fish in the right pond, you see the right deals. And then also you win the competitive deals, which you can win because you're Sequoia, or which you can win because you have an edge and you can prove that you can help them, or you do small tickets, you're flexible. So great asset class, and it's not rocket science even to do it. Just if you just stick to the basics purely based on track record, you will already construct a nice portfolio of funds. If you can add a layer that you can truly understand, one, the track records, two, this unfair advantage. Why do these funds have an edge? And if you can validate that with people because that's something we use. Usually we leverage our network to validate what we think about certain funds. Then you can really construct nice portfolios.
So it's almost like we're preaching to the priest, right? Because all our listeners do venture, but I want to bring this up on screen. I just grabbed this randomly from Google. This is literally what you're saying, right? You're saying, well, what really matters when you start looking at the top percentile. And I don't know if this is the best data set or not. I just randomly grabbed it. It says it's from PitchBook. So shouldn't be horrible, right? Should be okay data. But basically what you're saying, I don't know if you can see my mouse, is you're building your portfolio trying to capture this top bit of the venture capital pie. Yeah.
And we say we focus on top-decile funds, but the first thing I always say is this is actually fund top 5% to top 10%. The top 5% we're never gonna have. They're often very small, very niche, very often concentrated funds. It's not for us. Often they will be between top 5 and top 10 based on track record. If they then end up overall being top 20%, we're gonna have done a fantastic jobs.
Okay, different topic. The power of primary capital, and I'll leave it at that. Tell me what you mean by that.
Yeah, very important, because it's always very surprising to me. So you have the case, somebody 100 years ago starts a company, gives it his all, makes a lot of money, company goes through the sun builds it out further. Some point there's a liquidity event, they sell it. There's a lot of money. What happens? The young generation has the money, or has to, is like the steward of the money, because the stewardship thing is well understood with people. They're like, this is not really my money. I have to safeguard it. I have to make sure I grow it for the next generation. But then often what you see them do is they clamp down and they're like, but this guy worked his ass off and took all the risk. He made all this money. We need this money to be hyper safe. So we can only invest in US government bonds. I exaggerate a little bit, but so in super, what they consider safe assets or safe asset classes. Two things they miss is, one, look at the data and then do your asset allocation. And then two, the huge opportunity of actually doing something, one, for themselves, which would make them happier. And then especially, and that's what you referred to, failing to distinguish between secondary capital. Your investment is based on a transaction where you purchase shares from somebody else, from a shareholder who sells. Could be on the listed stock market, could be in private markets, but you basically give money for the shares. You don't give money to the company. And primary capital, which is you providing funding, oxygen, fuel to that company, for that company to realize its potential. In VC, you have the extra advantage. Not only you give the money to the company to realize its potential, but this is a company shaping the future, shaping a better, a brighter future. So the relevance of your money is huge. And it's much more fun. More money, more fun, more purpose.
Yeah, more impactful
What
for
we
sure. Yeah. I want to ask you maybe a bit of a provocative follow-up there. I agree with everything you said. Why do you feel that that's like one of your core learnings? Because I think for like people who live and die in venture, it's common sense, right? But you're coming from a different perspective. You're coming from that was a learning that now informs you. Could you explain that?
The primary why it is so
Yeah.
much more relevant.
No.
Or
So why is this one of your biggest learnings in venture?
I don't know if it's my biggest learning. No, but it's one of my biggest missions, I would say.
Okay, got it.
In Belgium, next to making Bluegrass a fantastic product and happy investors, I also want to move money, but a little bit, from everything that's parked in secondaries. And people say, oh, we don't do VC, into this asset class, which
You said in Belgium, I want to kind of drive or whatever the best wording there, doesn't really matter. I think we get the message. Do you feel there's still a culture shift in Belgium specifically amongst investors and private?
I think a lot. Yeah. There's still, Belgium by definition is relatively conservative. So many rich people, family office, whatever you call it, high net worth individuals are still thinking, okay, I have my own business. I can invest in my own business because I know it. I need to know things. Control, very important. And then, maybe the stock market, but even private equity is like the next step. But then at some point, also because there's lots of people in the ecosystem advising these families, which gets them on the path of private equity, which is a great thing. And then the next frontier will be venture capital. But as I said, many of our investors had never done VC. And so when I go there and we make a presentation about why the asset class, how to best do the asset class, and therefore why Bluegrass, people are always triggered and they're open to the idea. So it's going rather well in that department. They're open to learn things, but initially the thought is always VC, that's binary, that's risky.
Is that something that informed you a lot in building Bluegrass as a platform? And now I want to shift topics into, okay, what does this mean? What does platform mean to you? Because platform is a dangerous word. It means different things for everyone, right?
That's a good point. Because we had a call with a great fund last week. That's the big problem now. We have so many great funds we talk to. I'm like, which one? And I told them, look, we are a platform. So not only do we have our filters in place, which are just mechanical. We need to meet the filter. And then at some point, it becomes a point of our own conviction. How convinced are we this one will outperform, given what happened before and given how they're structured now and set up and what the environment looks like. But there's the second element also. But is this a fund we can raise 30 million for? Or maybe because it's a bit different, it's only going to be 10 or 15 or so. It's being able to sell it. And this often relates to established track records, large teams, not too close to home. So European funds sometimes are a little bit more difficult. Although Picus was the opposite. Yeah, it depends on certain things.
How do you work with your investors? Because I think a struggle I personally have. So we also invest and we co-invest with mostly individuals, to be honest, high net worths. And I am building a portfolio, right? I'm thinking about 3-4 bets per year. But I see that some of my investors or my co-investors are not. And that worries me. If I'm being very frank with you, that worries me a lot because I'm doing 3-4 bets into funds per year. So my portfolio is incredibly diversified. And then when I see like this individual or group of individuals that does 1 bet per year and that's it, and that's it. I'm like, oof, okay, does this person fully understand? How do you manage these, the fact that there's a portfolio construction view, but there's also some levels of freedom that the individual investors can have in these platform settings?
So first thing is that the information we provide them per underlying fund is like one pager, okay, the key elements, but then also a scorecard. In the scorecard, we give representation of one unfair advantage. Why is this fund so much better in terms of sourcing, screening, winning and managing the deals? We score them, we add some comments to it. And with that, I give the presentation. We have a video presentation. Then I go to investors and give the presentation, scorecard, and then track records. track record revealed, where also we share some findings we have when we do a deal by deal assessment of the track record. I would say, no, there we need to take correction. So we kind of give them a lot of granularity for them to make a decision. But as Howard Marks used to say, no amount of sophistication can allay for the fact that everything you know is about the past and everything you have to decide on is about the future. And then secondly, we tell them, look, there's two ways of dealing with bluegrass. Either you look at us as a platform and you use as such, you choose one underlying, and you pick and choose. Second one is the fund of fund approach. And unsurprisingly so, we have quite a bit of private equity professionals and other professionals investing also in bluegrass. And they always tend to choose the fund of fund approach because for them it makes sense. You put the same amount per fund, per underlying fund that meets these same criteria, and the overall quality of the product will be better. And then there's some people which I also understand because our family office is definitely like that. The patriarch, I'm also a bit like that. It's like someone asked me like this morning at a great meeting, a super nice guy. And he asked me, but what will make the best return if I have to invest in two funds? And I get that. I can also, like now we have 4, 5, 6 funds. And I can also say, to me, I think this one will be the best. Sometimes it's hard to say, but I'm like, this may be it. So, but that's why I say for us, super important to have these very established, very strong, with a strong, compelling value proposition and track record funds. That even if the one who just does one fund, plus the vintage year is amazing for us to start.
Yeah, because you've been investing for 2 years, right? As you said.
Exactly. So it's harder to get funds maybe, but you're sure that they're going to have a great return.
What do you think is your edge as an LP? In other words, why do you think the best VCs want you as an LP?
Mainly because we're nice guys, and because also because we raise large sums, and because they like lots of funds really like our model. They say, okay, that's great that you're not a 110 fund of fund, so to speak, but that you have super low fixed cost, nice strong hurdles, and only then you get a carry. So somehow they find that refreshing. What we don't do is what I call the Sequoia chasing, that we say, okay, we need to get into those super famous benchmark Sequoias, probably impossible. Anyhow, funds, and that we try via all angles, please give me an intro, we need to get in, put it there on the agenda. No. Plus, what would the job be and what would be the fun in that? How do you use Sequoia? They've been great forever. They get into all the deals. You can invest.
And what about co-invests? You're only co-investing with your portfolio funds. Am I right in saying that or not really?
No. For now, we have only done one, and it's not with one of our funds.
Okay.
In the beginning, it's with a great deep tech fund that I like a lot, and we do a lot with them. I also have I'm attracted to these deep tech things. I don't know why, it's always been like that. So with the family office, we did a lot of co-investments with deep tech funds, also because you can always get in. They always need money. It's easier than the hip software funds. And it's exciting. It's a real tangible product of. So no, but co-investments, people said initially investors, yes, we're interested. But then when we launch them, we feel it's always like, how can I assess this specific deal? So for now, we're refraining a bit from it, but we'll get back to it because for me, this is the most fun, analyzing the underlying companies. And if you already have the super filter of these top funds, so we may get there, but it's constantly evolving.
Do you worry or think or design against like the platform setup hindering speed of execution, or because you have the fund of funds setup, does that actually solve it for you?
No. We think about that. We think about that, especially because it's a fine balance. There's also technicality there that for Belgian investors, we cannot invest in Delaware funds. So we need a parallel route or we need an alternative.
These feeder vehicles,
Sometimes we can do it. But if we tell a fund, look, we can raise money for you, but we need a parallel route, even if we're really close with them, they will say, okay, good. But if it's only for 2 million, then we have a problem. And sometimes it goes quickly with these top funds. So then it becomes a little bit of a dance and a balance. Like, can we reserve a little bit? How much time do we get to have the reservation? And then we need to go out there and sell it. But definitely, it worries us also because we have quite a large AUM for now, but we're a little bit dependent on two big cornerstone investors. And if they're not there, then it becomes the amount kind of halves almost.
Now, it's interesting because there's pros and cons, right? As everything single model, and it's interesting also to hear how you think of it. Let me ask you, I think a lot of our listeners are emerging VCs, so many of them will be listening and thinking, should I reach out? Could you give us a bit of an understanding? Okay, what is the process? So when you get, when you start engaging with a fund, new relationship, let's say, so you don't know them before, you may have heard about them, maybe you even got an intro. What does the relationship look like? What happens?
75% of the case, we always have an intro coming from our network. So the funds themselves, fund of funds, tech family offices. Our network knows our criteria. So often there would be top-decile funds already. And we clearly say that, look, that's a condition. Otherwise, we don't even start, because we're not selling a top-decile story and then saying, look, this one is an exception and this one and then the third one. So that's already a big filter. Top-decile track record. Now we have the rising stars, although we're not going to do more than one per year of these. But then you need to be able to allocate a clear track record to one specific fund manager. So that's the funnel in. We talk to these funds. We say, okay, look, we need to assess one track record. We need to fully understand, and that's the most important part, the story. Why do you have an edge? So tell us, why is it because you're in the sector and you're the go-to fund in the sector? Is it because you're in the right place, a la Pioneer, for instance, and you're around like YC, you do top 20%, small tickets, you get in everywhere. Okay, this a story, a compelling story that makes sense. People saying, look, I have this wealth of super high performing companies and I get to pick and choose in which one of these I will invest more. Narrative, same in the region. They're always, the edge is the most important thing, the narrative as to why they will continue to outperform in the tracker. That's already big filter. And then third component, very important for us, is we ask our network, we ask our friends, funds, because we're large parties on the cap table of these funds, so we're very close with them. We're also on the LPACs. And so we ask them, what do you think of these guys and why and how? And it's a bit of a small world because we see lots of intros coming. I had this guy intros. It's coming back. Like
it's definitely, it feels more, and I think you said this, by the way, VC is more a community than an industry, right?
It's super community. And it's so not competitive in a great way. I mean, and it's very competitive to get into the industry and to be super well performing. But they're so nice. The funds will tell you, look, there's another friend of mine who's a great fund. You can also invest in them. They're not kind of trying to keep it to themselves, which is, that's the greatest thing about VC, is the quality of the people you meet. People are high caliber and that they're also nice with one another. So it's this feel good, optimistic, let's shape the future. Everybody helps a bit, but
I always say that. And that's why I've decided to focus on venture, because some of the most exciting, intelligent, and kind of interesting people I knew were working in venture. So my biggest kind of professional life design decision was, I want to work with great people. I don't care doing what. And that took me to venture. And then just kept on doing that, keep on engaging with cool people and learning from them and creating stuff with them. And I couldn't agree more. I think 100% in agreement with you. Final question from my side in terms of Bluegrass and everything. What's the ambition? What's the end game? What are you hoping to achieve that you can lie in your bed, just put your head down and feel, fuck, it's done?
Yeah, never. You know that doesn't work in life. That's a great thing. There is no pot of gold at the end of the journey. It's all about the journey. But what we'd like to continue, we want to be the best financial product in Belgium. I want to have my investors, even the smaller ones, have the best net IRR in their pockets of all the financial products they have access to in Belgium. So that's one. That's the most important thing. So high quality. And apart from that, I don't really have this goal like we should get there. We just go on. We push on. But I want to make sure that it's huge quality. I want to do it with investors that we like, that like us. It starts to feel a bit like a family, which is great. And you're so grateful to the investors supporting you. So I feel privileged to be a part of it.
I think it's a beautiful mission. Of course, it's Belgian focused, which is a shame for everyone else. But
it's not only Belgian focused, but in my mind, they have to get up. But at some point, we'll do something outside of Belgium as well. We're ready for it, but we need. Let's say for now, there's so much to do in Belgium that we focus here. If somebody opens me a can of interested UK, French, Portuguese, Singapore investors, by all means, it'll be my greatest privilege to go there.
Yeah,
and
of course.
But
it's a beautiful. I think it's a beautiful mission, because it sounds very dry, and financial driven for someone who's outside of maybe our small community and hub. But when you truly think about it, it's like making this asset class accessible, more accessible than it is, right? Because the lack of access comes from many angles, not only that you need to be quite wealthy, let's be honest. That's one, yes. But the other one is like, even if you are, getting access to these funds is not easy. So by building a platform, you can bring that all together and you can provide that access. I think it is a beautiful mission, because let's be honest, if you don't have the expertise to get into private markets, it's quite hard to get interesting returns on your capital. I don't know. I think there's more to it than just the numbers. I think there's a social angle to it, which is kind of beautiful to unpack
Yeah,
as well.
that's my second mission. That's what I explained before in the podcast, is get as much money as possible into fueling the future, into primary capital, in money that makes you proud at night when you go to bed. Like, at least this money is put towards a brighter future.
David, final question. What was the last book that you read that truly inspired you?
I read a wonderful novel. I think it's already 3 years ago, but it really touched me because I love fiction. Because my greatest moment of the year is I'm in the mountains in July or August, 2 weeks, no internet, family only, running the mountains and reading books. The Narrow Road to the Deep North by Richard Flanagan. It's a beautiful book about the love story in Australia and the prisoner of war camp in the Second World War. Australian POWs building the Thailand-Burmese railroad. It's a beautiful book, touching. And then I have a running novel, which I loved a lot as well, is Once a Runner. It's a bit of a cult book of the 1970s, although not many people read it. It's beautiful, about the travails of an athlete and how he trains, and I was like constantly obsessed with it, but written in a beautiful way. I don't think I have to give you tips of good VC books or other.
No. Neither do I care asking about that. I think it's just, I had heard of Once a Runner. The other one is new to me, so I'll have to check that. Anyway, David, thank you for joining. Thank you for sharing a bit about your passion around venture, your passion around Bluegrass and what you're building. We wish you the best of luck, and I hope you enjoyed coming on the pod.
I loved it. Thank you so much for having me. What a pleasure.
Thank you.
Take care, David.
If you are listening in and you enjoyed this, remember, drop us a review, follow the pod, and subscribe at EU.VC, and give us feedback. If you'd like to see more episodes like this, us to cover other topics, more specific topics, we're here to serve the community and the industry. So feel free to reach out.
Before we start the show, a quick note. If you're building or running a fund, you know it takes the right partners. At EUVC, we only work with sponsors we truly believe should be part of your tech stack. Please do take a moment to hear about them. And if you do, reach out, mention EUVC. It's the best way you can support what we do. Thank you so much. Starting off, HSBC Innovation Banking. If you're a founder, a scale-up, or a VC, you need a bank that actually understands your world. HSBC Innovation Banking backs innovation globally, from seed to IPO. And if you ask me, a strong banking partner like HSBC belongs in your stack. If your portfolio companies are scaling, they need infrastructure that won't slow them down. Google Cloud Starter Program offers $2,000 to $350,000 in credits, plus technical support to build better and faster. It's a key boost every fund should bring into their ecosystem, and oh my God, are we thankful to be partnering with them. Now, legal is a space you cannot lag on. Legal needs to move at the speed of venture. Goodwin's team has decades of experience with startups and funds. They're trusted at every stage from formation to exit. Goodwin definitely is a legal partner every serious manager should have in their stack. For Luxembourg-based VC, PE, and fund-of-fund managers, modern funds means going digital. Fundcraft gives you a full-service, digital native platform built for today's European managers. It's a must-have if you're scaling smart. So we all hear about the Middle East. How about you go there? From AI to deep tech to sovereign fund, Skytech in Dubai is where global future of tech gets negotiated. It's not just a conference, it's where East meets West, capital meets innovation, and the bold set the agenda. If you're playing on the global stage, join us going to Skytech this year. If you're gearing up for your next fundraise and want a placement agent who truly understands emerging managers, reach out to C Funds. They're a boutique placement agency that has helped GPs across Europe raise capital from top-tier LPs. We've been on the other side of the table here. They are actually good ones to work with. So I do urge you to go to cfunds.io to go and check them out. And hey, before you go, if you're looking to discover startups, raise capital, connect with innovation leaders, do check out dealflow.eu, the EU-backed platform bridging founders, VCs, and corporates. There's no better place to find the startups that have received significant funding from the European innovation ecosystem.
This was their finest hour.
Tear down this wall.
It's more than just an alliance. This is a union of values.
Let's start acting.